Three of the so-called FANG companies reported strong earnings this week. The NASDAQ, though, showing weakness at the end of the week. Of course, technology has been the leadership group since the beginning of the year. Joining me right now is the Bahnsen Group of Hightower Advisors founder, David Bahnsen. David, good to see you.
Good to be here.
Thanks so much for joining us. So tech was one standout on the downside this week. Yeah. Do you see that as a buying opportunity, or do you think the valuations in technology have become excessive?
No question. The valuations are excessive, and the dips this week are so minor that even if one wants to buy a dip, this wouldn't count as that dip. There's a lot of room to go to get to something that looks viable to us in that FANG aspect of tech.
Now, Apple reports earnings next week. That's obviously going to be one to watch. Would you buy Apple here?
It would depend how we own Apple now at the Bahnsen Group, and we would buy more if we got a big enough dip. But right now, we like where it's at. We like our weighting in it. I would expect the stock probably will come down a bit. It's also had a monstrous run this year, maybe not quite to the degree of some of the FANG names, but high 20% gain on the year. But really, the story with Apple when a new product cycle comes has always sort of been that it dips in advance of it. They end up outperforming, and on the back end of the release of the iPhone 8 is where you get maybe the next run up. So I'm not expecting it to jump, but if it were to dip enough, we could come back into that name.
Let's talk broader markets. We've still got double-digit gains from since Election Day, November last year. Would you put new money into stocks today?
I would, and I'll tell you, I think it is a great environment to be owning stocks right now. It's a rare blend of conditions where you have pretty low inflation and you have global conditions that are across the board better. I mean, you think back to where we were a year and a half ago. It's not just one or two places. It's emerging markets, but it's Europe, Japan, China, all of which have kind of settled. In the meantime, the real story is this earnings acceleration here in the United States. It's been fantastic. The problem, of course, is valuation. And then there's always this concern about Washington, D.C. and the ongoing volatility. But what I've never seen in my life is a decorrelation like this between what the market's doing and what D.C. is doing. The markets are shrugging off virtually anything coming out of the White House, anything not getting done on Capitol Hill. And I think the reason for that is a healthy earnings environment in corporate America.
Yeah, I mean, the first quarter we had profits up strongly, double digits, 14%. The second quarter, it's looking like 6-7% profit growth so far. So you are looking at just a strong fundamental backdrop. You think that's what's driving markets, not what's coming out of D.C. right now?
I very much think
coming out of D.C.
That's exactly right. And so you have a strong earnings environment, and there is still hope for potentially maybe a free call option on something good out of D.C. I don't think that they're overly worried. You remember where we were 6 months ago? We were optimistic about health care reform. We were optimistic about tax reform, but we were worried about trade. We were worried about some of the protectionist rhetoric. At this point, most of that has looked to be a lot more bark than bite, so you would think the markets would be happy about it, but then they're not getting the other things done.
All right, we will leave it there. David, great insights from you. Thanks so much for joining us.
Thank you for having me.
David Bahnsen joining us there. Don't go